Hello, and welcome to another edition of Enquirica Research Presents. Today on Enquirica TV, questions with product issuers. Hello, and welcome to another edition of Enquirica TV's Questions with Product Issuers. My name is Rick Purdy, and thank you for joining me on the program today. Questions with Product Issuers is an opportunity for investors to learn more and get a better understanding of alternative investment opportunities in the exempt market. The format of the series is to ask a standard set of macro and microeconomic questions of every issuer so that our viewers can get a consistent and unbiased overview of the opportunities available. Now, the first question for our guest on today's program is, tell our viewers the elevator pitch for your investment.
I'm John Bilder. I'm a Senior Vice President of U.S. Operations for the Jaymor Group, which means I run the U.S. portfolio for our real estate investment platform. The elevator pitch for what I do is that we have a historic opportunity to invest in the United States right now. The multifamily market was displaced incredibly over the last 3 years, and we've seen values decrease incredibly, and that's a perfect time to buy because fundamentals are returning, jobs are coming back, and we're going to see values increase over the next 5 to 7 years.
Now, if you could share with our viewers, what are your key macro drivers?
Key macro drivers really are demographics, and across the United States, we're trying to buy just in the Sun Belt, and demographic drivers there are quality of life, cost of living, and we're seeing a mass exodus out of the upper Midwest and Northeast down into those markets, and that creates apartment renters.
And what are your key micro drivers for your investment premise?
Key micro drivers, I look for jobs within the communities that we're buying properties. I look for age components. I look for retail, anything that increases the quality of life for the residents, and typically that means infill locations.
Explain in detail how you make investment decisions.
Generally speaking, I'm looking for return on cost and an IRR that is attracted to historic norms. That typically means that we're buying at a discount to current replacement cost. We're putting some money in, and we're able to grow rents up to market, which then allows us to sell back at a cap rate that is a few hundred basis point spread between return on cost. So generally speaking, from a metric standpoint, I'm looking for those kinds of spreads.
Now, one of the most important things for investors is, what is your exit strategy?
The exit strategy is to increase value, hold for a period, and sell back to the marketplace. Typically, equity firms like Jaymor and other leverage equity firms out there are buying distressed assets, and we're selling back to institutional owners.
What do you believe is your margin of safety?
I pressure test all of the deals on an individual basis, and typically we've got 10% margin in anywhere from rent growth to operational costs to exit strategy.
Do you use third-party leverage or bank financing? If so, why and how do you perceive this affects the risk profile of your investments?
We do, because it leverages our ability to purchase assets. We're a smaller fund that if we were doing an all-cash basis, it would decrease our buying power, and it would also expose those investments to individual assets. We like the leverage allows us to buy more assets, which allows us to bifurcate the risk across multiple assets. The leverage also increases returns to the investor. We are careful not to over-leverage the assets, and quite honestly, the U.S. lending market has done a much better job over the last few years in controlling that risk.
Now, if you could tell our viewers in detail about the founders, their backgrounds, past successes, and operational experience in the current area of investments.
Fab Lucchese is the founder of Jaymor Group, and he has been at this for 22 years. Successfully syndicated 21 deals in Canada on U.S. multifamily purchases. He's also been an active developer on his own account in both the United States and Canada. and he continues in the CEO position with Jaymor. I've been at commercial real estate for 15 years, mostly on the institutional investment side with GE Real Estate and Prudential Real Estate Investors before that. And we have a few other groups, but from an investment standpoint, Fab and I are the primary decision makers.
How are founders and management compensated?
Particularly in the Jaymor American Opportunity Fund, we are performance driven. So the interests are very much aligned with investors in that we receive small fees up front and for portfolio management to kind of keep the lights on. But profit participation comes from us when the portfolio does well overall. So the individual investors are the first to pull money out, and after a return threshold is met, we start to share.
How have you aligned the founders and management with investors' interests?
Well, I think that that last answer speaks to that. No one is more motivated to have these properties do well than myself and the other senior managers, because we participate when the deals do well.
What are the key downside risks, and how have you sought to mitigate them for investors?
The downside risks have mitigated themselves a little bit in the last 3 years by creating a trough so deep that we shouldn't be seeing it again. That's really where the buy opportunity is. I think beyond that, we mitigate our risks by controlling management and accounting at the property level, and also managing construction and acquisition from the United States.
What are the upside possibilities? How do investors benefit from them?
Well, the Opportunity Fund is not a fixed return, so when the properties do well, the fund investors do well. I think the upside is really hard to quantify at this point because we don't know exactly where the properties are going to go, and that's the unknown about a 5 to 7 year investment. But I try to buy assets with realistic underwriting that really can produce 20 to 30% IRRs at the property level.
Overall, what type of returns are you providing to investors? Is it a yield, growth, blend, inflation hedge, or capital preservation tool?
Well, on the round trip assets, I think that we've measured success on capital return, and on the deals that we've fully liquidated, in most cases we've been over 200% return on capital. Most of those investors have gotten a 2 to 3x return on their money. The Opportunity Fund's a little bit different in that they will be getting a current return on their investment, but also participate on the sales of those assets. And we haven't monetized any deals that we've acquired at this point, so it's difficult to quantify that.
You've been watching Enquirica TV. Enquirica is a Calgary-based firm focusing on independent analysis of alternative asset classes. Enquirica has an archive of general research across a broad range of topics and interviews with newsmakers and entrepreneurs about their perspective on the economy and their sectors, with a view to providing unique and timely information from a non-mainstream perspective.